Hello and welcome back to our third series of videos. In this next series of videos we're going to discuss Chapter 3, and Chapter 3 talks about job order costing. So basically we're continuing our discussion of Chapter 2 into a new chapter. In this chapter we're going to get into the real nuts and the bolts of job order costing. So we're going to look at how costs flow through the accounting system, as well as some external reporting that we're going to need to do when it comes to job order costing. Now, before we jump in to the nuts and the bolts and the inventory accounts and how costs flow from one inventory account to another inventory account, we need to review some very important vocabulary terms that we learned last chapter. Okay, so we have 7 vocab words that we need to make sure we understand before we move on, as well as learn a few new vocabulary terms. So the first one is job order costing. We talked about this at length in chapter 2. Remember, job order costing is a costing system that is used by companies, organizations that produce many different products or jobs or services each period, right? Each of those products, jobs, or services are unique in the sense that they are designed to customer or specific customer specifications. And remember, we need to be able to not only trace direct costs to specific jobs and services, but we also need to be able to allocate that overhead to those specific jobs and services. The book talked a lot of, or a little bit really, about absorption costing. We really didn't mention it in the video or in our lecture video series. However, it was a question in your study guide, right? Absorption costing, what is it? Well, it's also a costing method as well. However, absorption costing includes all manufacturing costs, right? All direct labor, all direct materials, all fixed and variable manufacturing overhead in the cost of a product, okay? When we get to absorption cost, or I'm sorry, activity-based costing, we'll see in variable-based costing, we'll see how those costing techniques differ from absorption costing. Okay. Um, Remember, we have to know how to calculate the predetermined overhead rate. We saw that in chapter 2. We discussed it. We went through a number of examples showing how to calculate that predetermined overhead rate, right? So we need to know what the allocation base is. That allocation base, that's our cost driver, right? The allocation base, it's nothing more than a measurement of activity, right? We saw that we could use direct labor, we could use direct machine hours, we could even use direct labor dollar hours, or direct labor dollars if we wanted to. And one of those 3 measures of activity is what we use to assign the cost, that overhead, to a cost object, whether that cost object is a job or a product or a service. We know what the predetermined overhead rate is, right? We use this to charge that manufacturing overhead to each job, okay? Excuse me. Hopefully by now we know the predetermined overhead rate formula or equation. We should have that memorized already. Remember, we take our estimated total MOH divided by the estimated total allocation base or cost driver. Okay. Excuse me. We talked about overhead a little bit in the sense that what we're doing with that manufacturing overhead, we're assigning that overhead cost to those jobs, right? And we know how to assign overhead. Remember in chapter 2 we said, hey, we take that predetermined overhead rate and then we multiply it by the actual cost driver or the actual allocation base that was incurred by the job. So again, that allocation base or that cost driver, those are going to be kind of euphemisms for each other or synonyms for each other. Okay, we're talking about the same thing whether I say allocation base or cost driver. It's either that direct labor hour or that machine hour. Okay, remember we saw the job cost sheet, right? That is a record. I don't like that word record. Basically it's a sheet of paper, or it could be a page in a software system, whatever, or a screen in a software system rather, that allows us to record and keep track of direct material, direct labor, and also allows us to apply or to charge that overhead to those jobs. Okay, so now what we're going to get into, the nuts and the bolts of chapter 2, or chapter 3, excuse me. Okay, so I like that little review that we have here. If some of those concepts are still a little foreign to you, please make sure you go back and study those before you move on, okay? Because we need to know how to allocate overhead. We need to know the predetermined overhead rate calculation. We need to know how we allocate or charge overhead to a job. Now we're gonna kind of switch gears a little bit and we're gonna say, okay, we know how to do all that stuff. Now what we want to see is, what does it look like in the record keeping system? Meaning, how do costs flow in the job order costing system, right? What are the journal entries that we use? Hopefully, I'm gonna assume here that everybody has experience with journal entries. You guys did have the prerequisite for this course, that financial principles, or that Harvard Business Review course for financial accounting. If you have any issues with journal entries, you know what to do. Text me, call me, email me, whatever, and we'll work on those. T accounts, I don't know. I looked over the roster. Some names look familiar, but I don't think I've had any of you guys before. There's one name that actually looks familiar. I might be construing it with another student. But anywho, if you had me for financial principles, I tried to show the students in that course T accounts. T accounts are sexy. All right, T accounts are the greatest thing on earth because they really help you see how the costs flow through the accounting system, right? So we will talk about debits and credits and whatnot, and I'll try to provide a little review as we go through that. Okay, so before we even jump into how costs flow, we're going to have some new accounts that we need to learn, right? First one are raw materials, right? We did talk about raw materials a little bit in chapter 2. Remember, raw materials in this example include any materials that go into the final product, okay? So when I say raw materials, right, you might think, well, if I'm making, I don't know, glass, right, there's raw materials that go into glass, like I need sand and chemicals and you know, all that other stuff, right? We're not talking about, when we say raw materials, we're not talking about like natural materials that we, you know, like trees, right? Trees are raw materials. In our case, or in our situation here, raw materials include any part that go into the final product. So let's say we're Ford and we're making cars, okay? And we put steel into our cars, right? Obviously we have the steel frame, we put glass windshields in there, we put radios in, right? The radios or the CD players or whatever that we put into that car is a raw material for us, right? As we're Ford, it becomes an integral part of that final product, it is in fact a raw materials. Guys, I want to apologize if you can hear my dogs barking. They go insane on Saturdays. Anyways, so raw materials, anything that becomes a part of the final product. Work in process. This is an inventory account, okay? I want you to think of these accounts really as buckets, okay? And they actually hold costs. So just like you can put a physical product in a bucket, imagine, if you will, that physical product or that physical thing has dollar signs attached to it. Okay, if you could think about it in that fashion, I think that being able to explain how costs flow will make a little more sense. So work in process, again, it's a bucket. It holds all the units of products that are only partially completed. Okay, meaning back in chapter 1, I believe it was, we had an example of a bike, right? We used bike manufacturing as an example. Okay, well, let's say we have a bunch of bike frames with wheels attached to them. Okay, that bike frame and those wheels have a cost, right? They have dollar signs attached to them, right? Direct labor, direct material, or raw materials. Well, it's not completed, it's partially completed. We still got to put the chain and the sprockets and the seat and the handlebars and the brakes and all that other stuff on it. So think about that bike as actually sitting in a big bucket, and that big bucket is called work in process, right? Finished goods, those, and again, finished goods, it's an account that we have, but think about it as a bucket. Finished goods is a bucket that holds all the completed bicycles that we already produced, okay? And again, we're thinking that we have a finished bicycle. We think about it in our minds, we see dollar signs attached all to that bike. Direct materials, or raw material dollar signs, direct labor dollar signs, overhead dollar signs are all attached to that bike. It's now sitting in that finished goods inventory. Okay, then we have this thing we call cost of goods manufactured. Okay, we're going to actually later on in another video put together the cost of goods manufactured schedule. Okay, so what is the cost of goods manufactured? Well, again, this is the manufacturing costs that are associated with the goods that were finished during the period. Okay, so finished goods inventory, right? We have it. We have a big bucket. Okay, well, of all those finished goods, what are the cost of goods manufactured? Okay, spoiler alert, probably not going to be equal to the finished goods account. Okay. Okay, this slide is very, 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 very important. Okay, now I know you guys really aren't accountants. You guys are going for business degrees, food studies, sustainability. I get that. So what do we need to know? Well, think about it. Regardless if you're sustainability, MBA, food studies, whatever, you still got to know in any business, okay, how do costs flow? Where do they show up on the financial statements, right? Because financial statements is what we use to get our information. Okay, so we're making decisions about costs. We're incurring costs, we're incurring direct labor, we're making purchases of raw material, we're applying overhead. Where do they fit in the financial reports, right? So think about it this way. We got to go back to chapter 1 and we got to remember product and period costs. Okay, remember, period costs are expensed when they are incurred, right? As soon as they happen, we expense them. Our period costs are our selling and our administrative costs. Those costs always, always, always flow directly to the income statement. Okay, then we have our product costs, our raw material purchases, our direct labor costs that we incur in the manufacturing overhead. Where do those go? Well, those travel a little bit. Okay, think about it this way. Raw material purchases, where do they show up at? Well, they always show up on the balance sheet under our raw materials inventory account. Okay, so anytime we incur a cost to buy raw materials, and again, a raw material is nothing more than a material that goes into the final product. So a radio is, like a car radio. It's completely, it's a finished product for Sony. But for us at Ford, we consider that a raw material. So keep in mind that one company's finished good product can become another company's raw materials product or raw materials inventory. Okay? So again, raw materials, whenever we incur a cost, we're always going to we're always going to hit our raw materials inventory account. Okay? Then we incur direct labor costs. We allocate or charge manufacturing overhead. Where does that go? Well, that always goes to work in process. I'm going to use the acronym WIP, W-I-P. It stands for work in process inventory. Okay? So think about it this way. We incur raw materials, we purchase raw materials. It flows to the balance sheet as a raw materials inventory, under raw materials inventory. Okay? As we start producing and we start making things, well, it's going to start off, obviously, those products are going to go to our WIP bucket, right? Because we're adding raw materials, we're adding labor, we're adding overhead. Okay? So as we're making stuff, the costs flow to the balance sheet. Okay? They either flow to raw materials inventory or work in process inventory, depending on if it's a material cost, a labor cost, or we're charging overhead. Okay? Once that product is complete, it leaves WIP and it goes into the finished goods inventory account, which it sits on the balance sheet. Okay? So basically all our product costs first flow to the balance sheet, right? Once they're at their end stage of the balance sheet, which is finished goods inventory, once they are sold, then we recognize the expense, and the finished goods inventory that is sold moves to the income statement as cost of goods sold. Okay? Very important slide. Please look over this, make sure you understand it, rewatch this portion of the video for the explanation. If something's still not jiving with you, please text me, please call me. Okay, so let's look at an illustration here to really explain how job order costing flows. Okay, so we have a company here, looks like Ruger Corporation, right? They use job order costing. They must manufacture something. Okay, Ruger is a producer of gold and silver commemorative medallions, and it works on only 2 jobs in April. Excuse me. Okay, so right now this says job order costing all over it. Why? Well, because they make 2 products that are different. They're medallions, and they have 2 jobs, job A, job B. Job A, they have to mint 1,000 gold medallions commemorating the invention of motion pictures. Okay. They give us more information. They say, hey, job A, it's been assigned $30,000 in manufacturing cost. It corresponds with Ruger's work in process balance of April 1st. So what that means is, as of April 1st, we look at the balance sheet. Okay, and the work in process inventory account already has $30,000 in it. Okay, what does that mean? Well, what that means is they've already started working on job A back in March. Okay, so April 1st, we open up the office or the production plant. We walk in, and guess what? We walk over to the bucket of WIP. We look in it, and there's partially completed coins, okay, that have a dollar sign attached to it of 30,000. Now job B, they need 10,000 silver medallions commemorating the fall of the Berlin Wall. This was starting in April and was incomplete at the end of the month. Okay, so as of April 31st, we're going to walk to at the end of the day, we're going to walk to that bucket of WIP. We're going to look in it, and guess what? There's going to be some amount of silver coins with dollar signs attached to it. That represents job B, because job B is not finished. It's still sitting in our WIP. Okay, So let's look what happens, and let's look at now these, by the way, this is a T account, okay? When we look at the T account, we actually have three accounts here. We have our raw materials account, we have our WIP account, and we have our manufacturing overhead account. Now, the left side is the debit side, the right side is the credit side. We will be dealing with assets here, okay? Because remember, raw materials, overhead, work in process, raw materials and work in process are asset accounts, okay? So remember this, we increase an asset with a debit. So we need, on the left, we increase it. We decrease an asset with a credit, the left side, okay? So let's look and see what happens. Well, we purchase raw materials, okay? We're not worried about the dollar amount yet. What do? Well, we purchase raw materials, so that means that we're gonna debit, or we're gonna have a left entry for the materials purchased. So we debited raw materials to show that we purchased something, okay? Then something happens. What happens? Well, the inventory, or the raw materials department, gets a, ready for this, materials requisition form from chapter 2 and says, hey, we need some materials. Okay, well, what do you need? We need some direct materials, we need some indirect materials. Great. So as those materials flow over to the production side physically, what happens on the accounting side of things? Well, the direct materials decrease, or the direct materials need to leave raw materials and go to the work in process account. Okay, so we need to decrease raw materials, we need to increase WIP. Okay, not a problem. Raw materials is an asset, we decrease an asset with a credit. WIP in process, or work in process, or WIP, is an asset account. We increased an asset with a debit. So that's why we have the credit side of direct materials going straight to the WIP. Okay? And that's why we see it on the left side there, because it's increasing. Now, indirect materials, where do those flow to? Indirect materials, indirect labor, all the indirect costs flow to the manufacturing overhead side. Okay? Now look at manufacturing overhead. This is really important here. The left side represents the actual costs. The right side represents the applied costs. Okay? So we actually incurred some amount of indirect materials for this job. Okay? We need to leave raw materials. How do we get it out of raw materials? With a right side entry or a credit entry. Okay? Our manufacturing overhead goes up, right? We're recognizing that we actually incurred this expense. We see a right side entry, or excuse me, we see a left side entry, because that's what actually occurred. Okay? So what does the journal entry look like? Well, the journal entry looks like this. Okay? On April 1st, Ruger had $7,000 in raw materials on hand. So we already had $7,000 sitting in raw materials inventory. Okay? During the month, the company purchased on account an additional $60,000 in raw materials. Okay, what's that mean? That means that they went to a supplier and said, hey, we need $60,000 worth of raw materials. We can't pay you right now, we'll pay you later. Our supplier said, not a problem. On our books, we say, okay, we need to debit, which is the left side, raw materials inventory account, and we need to credit accounts payable, which is a liability. Okay? Raw materials increase with the debit, or I'm sorry, assets increase with the debit, which is the left side. So the left side here of these two columns, or the left column here, is going to be debited for 60,000, and then we have obviously the liability being credited. Okay, let's look at the next one. Now, let me go back actually one. So what happened here, and this is our T account form, we see the debit of the purchase of raw materials. Okay, where's that credit for accounts payable? It's not on here, it's someplace else. Okay, we're not worried about that per se. We're worried about showing how these product costs flow through the system. Okay, now during April, hey, we had a materials requisition form, right? They were prepared to authorize, a withdrawal of 52,000 in raw materials from the storeroom for use in production. Okay, the raw materials include 50,000 of direct and 2,000 of indirect materials. This entry right here records issuing the material to the production department. So physically, we take a paper to the storeroom and say, hey, give us 52 grand worth of raw materials. Put it on a cart and we will it over to the production department. Great, we get that, we understand that. How does it look accounting wise? Well, remember what we're doing here. Raw materials are leaving the raw materials account. Okay, just like the storeroom represents that raw materials account, just like those materials physically went onto a cart and rolled out, the costs that are associated with that need to roll out of the accounting books. Okay, in order to get that to happen, we credit, and that's this one down here, raw materials 52,000. Okay, now work in process, and this is key. This is clutch right here. Got to remember this. Got to know this. Direct materials always flow directly to work in process. Okay, so that's leaving the storeroom, going to the production department, right? Physically. Well, envision the production department as the WIP, work in process inventory account. Okay, so as all those physical pieces show up to the production department, those direct costs also flow to the work in process inventory account. So work in process is a debit, or excuse me, work in process is an asset. We increase assets with a debit. That's not why we see this 50,000 on the left side of these two columns here. Okay, now manufacturing overhead. Remember, this is the account we use to actually apply overhead costs. Okay, this manufacturing overhead account, it's kind of a special account, so to speak. So what I want you to do physically, if you can think about it, the production department is the WIP. Maybe a small corner of the production department, we have our little manufacturing overhead bucket. Okay, what's key to understanding here is manufacturing overhead holds all the indirect costs. All the indirect costs are held in manufacturing overhead. Okay, so manufacturing overhead, what we apply is on the right side. What we actually incur is on the left side. So because we're actually incurring $2,000 of indirect costs, we have a debit entry, which is the left side here. Okay, let's go back to those T accounts, right? So what's happening? Well, see this right here, this direct materials and raw materials? This whole amount equals 52,000. Okay, it's leaving raw materials, so we have to credit it, or we need if we're looking at T accounts, we need a left entry, or excuse me, we need a right entry. We need a right entry here. Direct material, and this is clutch, direct materials always flow to work in process, right? So we have our debit to direct materials. Left side is a debit. We have that left entry. indirect materials, those also flow to the production department, but we got that little corner where we keep our manufacturing overhead, and we see that the indirects leave raw materials and flow into the debit side of manufacturing overhead, which is the left side, and we see the actual indirect material costs incurred. Okay, so remember, let me do this here, bear with me for a second. Okay, so this is the left side, this is going to equal the debit side. It's supposed to be a D, sorry. This right side over here equals the credit side. And because these are assets, the left side, the debit side, is our increase. The credit side, or the right side, is our decrease. Decrease side, okay? And then remember, overhead, the left side is the actual cost that we incur. The right side right here, or the credit side, this is what's applied. This is where we use the predetermined overhead rate. Okay? Okay, so now we need to record labor costs. Okay? Guess what? Labor costs are handled the same way. Okay? So remember, if we're looking at an asset, come down here. If we're looking at an asset, debit increases, credit decreases. Okay? So we have our wages payable account. All right? And by the way, that's supposed to be an A right there for asset. Okay. The salaries payable account, this is a liability account. Okay. So the liability account is just the exact opposite. We increase the liability with a credit, we decrease it with a debit. Okay, and remember, left side is going to equal the debit, right side equals the credit. Okay, so here's what happens. We need to book direct labor, or our labor, right? We incur labor costs to produce something. Okay, that makes sense. We get that. We need people in the production floor, you know, hooking up the chain to the sprockets and fastening the wheels to the frame and putting the seat on and all that good stuff, right? So direct labor, and when you see salaries and wages payable, just think of this as labor cost. That's really all it is. Okay, just a fancy name, a fancy accounting term for labor cost. Okay, now remember, all direct costs flow to WIP, all indirect costs flow to manufacturing overhead. Okay, so what happens? Well, people do work. We need to pay them, right? Well, we're not going to pay them now, we'll pay them down the road. So we establish a liability. So we have a credit to increase our payables, showing that we have incurred labor costs. Okay, this direct labor flows to the WIP account, and it does that by being debited. Okay, the indirect costs flow to manufacturing overhead. Because it's indirect labor, it's costs that we actually incurred. That's why we need to debit our manufacturing overhead. Okay, so let's put some numbers to this. Oh, sorry. Let's put some numbers to this and let's see what happens. Okay, so in April, we got the employee time cards or the time tickets, right? And we see that 60,000 was recorded for direct labor. So that means all the labor we had, whether it's, all the direct labor is $60,000 and the indirect labor is $15,000. Okay, so conceptually we know where these accounts flow, right? All the direct labor costs have to go into our work in process. All the indirect labor needs to go to the overhead. Conceptually we understand that, right? We just saw the slide previously. Okay, so how do we make that happen? Very easy, right? We're going to debit work in process for $60,000. Okay, why? Well, because we incurred direct labor cost of $60,000, we need to increase our WIP account by that $60,000 because that's direct labor. All direct costs flow to WIP. The manufacturing overhead, right? $15,000 of indirect labor. Maybe that's the manager, the production manager, maybe it's some security guards, whatever, right? It's something that's indirect. We can't easily and conveniently trace it to a specific product. It's an actual cost we incurred. We need to show that, hey, we incurred this. Let's get it into the manufacturing overhead account. We do that with a debit. Okay, so again, just like material, how we thought about physically those products leaving the storeroom to the production plant, think of direct labor in the same way. Okay, those direct labor people are on the shop room floor. That shop room floor represents our WIP bucket. So as we see people fastening wheels to the frame of the bike and putting the sprockets on the frame and the chain and all that stuff, we're seeing that direct labor dollar sign being attached to those products, which again are in WIP, the WIP bucket. Okay, the manufacturing overhead, that's the small corner of the production department. Well, let's say that's the manager's office. Okay, and that little bucket right there where the manager sits, that's all the indirect costs. Okay, so we're putting his $15,000 of cost that he earned to that bucket. Okay, again, we need a credit, so we're going to credit wages payable for $70,000. So this journal entry we see right here, we did the logic or conceptually, these words that flow from one account to another, we put them in word form, or we put them in, we assign numbers to them and say, okay, here's what it looks like in journal form, right? This is what it looks like in the accounting world. Okay, now the next thing that we need to look at is our overhead. Okay, so if we have overhead that we actually incur, these are things like bills that we actually pay, like the lighting, right? Can we the lighting, the heat, the water, the property taxes for the production department, can we easily and conveniently trace those costs to a specific unit of a product? No, right? Think of the warehouse or the shop floor, right? We're incurring costs to produce something that we can't trace directly to that product. So we're gonna, in that case, then we're gonna debit manufacturing overhead, and those are those other costs. Okay, now how do we do that? Well, it's easy. Okay, let's assume that this Ruger company incurred the following costs, right? Utilities. Okay, that makes sense, right? 21,000. Rent on factory equipment. We rent equipment apparently, 16 grand. We have, other miscellaneous factory overhead costs. Those are things like maybe like grease for the machinery, oil, stuff like that. Just incidental costs, miscellaneous costs that we need to keep the production going. Okay. What do? Well, we're going to debit, which we see here, $40,000. Okay. Incidentally, this $40,000 is the sum of the 21, the 16, and the 3, in case you're wondering where we got that from. Then we're going to credit accounts payable. Okay. For right now, we're just going to say accounts payable. In actuality, other accounts are going to be credited, such as, if we pay cash, we could credit the cash account. Don't get too hung up on that. As long as you can understand that we need to debit manufacturing overhead for all these other overhead accounts that are actually incurred, the credit to that is we're just going to say it's accounts payable and be done with it. Okay? So now let's put all this together, right? We have our direct labor, we have our direct material sitting in the WIP, right? We already acknowledged that we recognized all the actual overhead cost that was incurred. Okay, now we got to apply, right? Remember, we apply based on estimates that were calculated at the beginning of the period, right? We had no clue what our actual costs were going to be. We had a guess. We had an idea, so we guesstimated or estimated what they were. Now we need to apply. So we're going to apply based on the predetermined overhead rate. Okay. Now, how do we do that? Well, we apply with a credit, and we debit the WIP in process account. So we could see that right here, right? We're applying. We're applying overhead from where? Well, from this manufacturing overhead account to the WIP account. Okay. Now, in the real world, actual and applied overhead never going to equal. Okay, at the end of the year, we're going to have to make an adjustment. We'll see these adjustments later, but we already laid the groundwork for these, right? Remember in chapter 2, at the end of chapter 2, I says, hey, you're going to need to understand this as far as underapplied and overapplied and how we fix it. We're going to see the nuts and the bolts a little later on how to fix it, right? But we already know conceptually what to do, right? All right. Okay, so in our example here, we have a predetermined overhead rate of $6 per machine hour, right? We also assume that in April, 10,000 machine hours were worked on job A, 5,000 were worked on job B, so that's a total of 15 machine hours. Okay, so what we need to do then is we need to take our predetermined overhead rate of $6 per machine hour times the actual machine hours that we used in total, 10,000 for job A, 5,000 for job B, that's 15,000. We're going to apply overhead of $90,000. Okay, we're going to debit WIP. Why? Because debit's an asset. We increase assets with a debit. That's why we have that's why we saw this left side here. This is the debit of overhead applied. We're going to credit manufacturing overhead, 90,000. Why? Oh, because the apply side is the right side or the credit side. Okay? Now, we have non-manufacturing costs, right? We don't assign these to jobs. We expense them when they occur, right? These are our period costs. Non-manufacturing are the selling and the administrative costs. So what do we have? Well, we got the salary of employees who do not work in manufacturing, right? Maybe the accounting department, the marketing department, anybody that works in corporate office, right? The corporate side of the business. Those are going to be our period costs, okay? Advertising expense, selling expenses, things like that. Those are all period costs, okay? So again, those show up on the income statement. This is just an example of the non-manufacturing journal entries. You could go over those on your own. Really not too concerned with that at this stage. Actually, I'm not concerned with that in this class. As long as you know from a manufacturing or from a running the business standpoint, and you got to talk to somebody in finance, and you're making decisions based on costs, as long as you know is those administrative and selling and administrative costs flow straight to the income statement, they're not on the balance sheet, you're fine. Okay? So, where are we at now? Well, we're talking about product costs and how they flow, right? So we, up to this point, have gotten all our costs into WIP. Okay, so they're sitting on the production floor, right? Direct materials, direct labor, overhead applied. It's sitting, excuse me, in the bucket, which is the production floor of WIP. Okay, production has been completed, right? Meaning we've completed everything we have here. Okay, it's complete. Where does it go to? Well, guess what? It leaves the production department, and let's say it goes to the shipping department. Okay, guess what? The shipping department represents our finished goods inventory account. So think of the shipping department as the bucket that holds all the completed finished goods. Okay, so as those physical units that are completed that have all those cost dollar signs attached to it leave the production department and go into shipping, what happens in accounting, in the accounting world? In the accounting world, we need to get those costs that are associated with WIP out of the WIP account and get them into the finished goods account. So just like those physical products actually flow, these costs are going to flow. Okay, how do we do that? Well, again, we got to go back to that pesky accounting, right? And remember, we have the left side and we got the right side. So we know that the left side is the debit side. I'm going to abbreviate and say DBT. The right side is the credit side. I'm going to abbreviate and say CDT. Remember, this is an asset, or these two accounts are asset accounts. We increase an asset with a debit, we decrease an asset with a credit. So as these physical units leave production, the production department, we need to get the costs out of that work in process inventory account. We do that with the credit. So we see the costs, the dollars going down, leaving. Where do they go? To the finished goods account. So that's why we debit this finished goods account to increase it by the cost of goods manufactured. So this is the cost of goods manufactured here. Remember that definition we looked at earlier. This says, hey, this is the cost of all the completed goods. Okay? So let's see an example, right? Let's put some numbers to it. All right, job A has been completed during April. Job B was incomplete at the end of the month. Thus, the following entry for the costs from job A from work in process to finished goods. So 158,000 of WIP leaves WIP and goes into finished goods. Okay? Remember, job B not completed yet. Okay? So guess what? We're going to have costs still remaining. Let me go back up here. We're going to have costs still remaining in this WIP account. Okay? In this WIP account, we're still going to have a balance here. Okay? That balance, BAL, that balance represents job B. Okay? So that's pretty much how costs transfer. Okay? Now, what happens once the goods are sold? So the goods are sitting physically in the shipping department. The shipping department slaps a label on them, calls the calls FedEx or UPS or the mail USPS and says, "Hey, I need you to come pick up these bicycles and send them to Target in, I don't know, Okie-Skokie," right? Okay, great. FedEx shows up, picks up the bikes, puts them on a truck, takes them to Okie-Skokie. Well, as those physical bikes leave, what happens, or what happens in the accounting world? Well, we need to get rid of these finished goods account, right? Finished goods is an asset. Okay, so how do we decrease an asset with a credit. So cost of goods sold are going to be credited, and they leave cost of goods sold account and they show up on the or under the cost of goods sold account as a debit. Okay, now when finished goods leave the finished goods account and flow to the cost of goods sold account, they are leaving the balance sheet and they are showing up on the income statement. Okay, so we have an asset that we sell. As soon as it's sold, it's not an asset anymore, it's an expense. Okay, so here's how it looks. Here's the journal entry to recognize the sale. Again, notice this bottom one here. This is the main one I'm concerned with, number 11. Recognizing that finished goods is an asset, we need to decrease it. So we're decreasing it by $118,500. It's obviously the amount that we sold, and we're transferring it, so to speak, to our cost of goods sold account, which is a debit. Cost of goods sold is an expense. We increase expenses with a debit. Okay, so there was a lot here. There was a lot to take in. Okay, when we come back, we're going to look at the schedule of cost of goods manufactured and the cost of goods sold on the income statement. Okay, right now you got to be able to understand first conceptually how the costs flow, right? Meaning, how do raw materials flow? Where do they flow to? Labor costs, where do they flow to? Both direct and indirect labor, where do they flow to? Recognizing that, hey, this manufacturing overhead account, the debit side or the left side has all the costs that we actually incurred. Okay, the applied side, well, that's the right side, and we apply it to WIP. Okay, and then obviously recognizing, okay, well, once these goods are completed and finished, how do we get them? Once we get them out of WIP, where do they go? They go to finished goods. This process of getting them out of WIP and into finished goods is called what? Cost of goods manufactured. Okay, and then once the goods are sold, they're finished goods. They're sitting in our finished goods account. How do we get them out of finished goods into the cost of goods sold account? Well, we have to, obviously hit the right side of the finished goods, which is a credit, and we have to debit our cost of goods sold. Okay, that's the main takeaway here, and knowing the journal entries will definitely help. Okay, if this was still a little confusing, I get it. Okay, focus on those slides, and especially in the reading, and you should be okay. All right, again, if you have questions, you let me know. When we come back, we're going to see how to prepare the cost of goods manufactured statement as well as the cost of goods sold. Okay, if you logically or conceptually understand how these costs flow and what accounts they move to, you're going to be fine. Okay, the second step is recognizing, well, is it a debit or is it a credit? Okay, so please tune back in for our next video.